how rental cash sharing works, and why it beats everything else. I have spoken to thousands of landlords, and they almost tell me the exact same thing. I was told real estate would help me reach my financial goals. But since I bought it, I don't feel any richer. I don't feel any different than I did last year. And I'm not sure it's really helping me. So you got into real estate, you're excited for the day it would help start build your wealth, and that day seems to be never coming. Then the rental market softens, it might be a negative cash flow, you're topping it up with your own pocket, and now you start wondering, it's like, oh my goodness, did I make the wrong decision? Or did I buy at the wrong time? Part of you wants to sell, but the market is slow, you don't want to lose money. So let me say one thing to you right now. You are right to buy. You're right to make that good financial decision. You have all the pieces in place. You're just missing one piece, and that's the strategy. So please, 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 my friends, do not sell before talking to me. Selling on an emotion is the most expensive mistake you can make as a landlord. Hello, everyone. My name is Sylvia Ho, and I'm a financial landlord consultant. I'm also known as the Cash Dummy Queen. I work solely with landlords to help them save money, reduce taxes, and cut the interest that they pay the banks. So whether you bought real estate for retirement income, or to build wealth, or to buy for the bloodline so your kids and grandkids can have something, the one thing holding you back is the same. It's cash flow. Because the two biggest expenses for Canadians are the taxes that we pay and the mortgage payments that we make. So today, I'm going to show you 3 ways landlords usually try to solve this, and then I'm going to show you the one that actually works. So number 1, this is the one that everybody reaches for first. They just throw as much money to the mortgage as possible. You pick up a side gig, you work more overtime, you cut back on vacations, you cancel a subscription. But here's the problem, my friends. In Canada, the more money you make, the more you're actually feeding the government. You work those extra hours. A big piece goes to the government before it even reaches your bank account. But the part that actually costs you the most is not about the money. It's actually about the hours that you spend away from your family that you can't get back. So don't sacrifice your life today for a finish line that's 30 years away. That's not a strategy. That's suffering with extra steps. Number 2, hunting for the lowest rate. Every renewal, everyone does the exact same dance. Who has the best rate? Can you beat this? Let me shop it around. Now, listen, I'm a mortgage agent, so I get it. But the fraction of a percentage that you save is just a few dollars a month. It's all about having the right strategy, the right structure in place that can actually shave off 8 to 12 years off of your current amortization. And here's what I say. Rate is a trap. Strategy is your freedom. So please, my friends, don't chase pennies to step over dollars. And lastly, number 3, us landlords have done this before, and it's actually one that makes things absolutely worse for you. You decide to attack the mortgage on your rental property. You set up biweekly accelerated payments. You get a bonus and you put it onto the rental mortgage. Now, I know that it feels responsible and it feels like that's what a good landlord should do, but you're actually making it worse for yourself. Because you have to think about it. The interest on your rental mortgage is actually tax deductible. It's good debt. It's debt that's working for you. Now, the interest on your mortgage home, your home that you live in, is not tax deductible. You get nothing back from it. So that's bad debt. So by paying down a debt that's actually helping you, it's actually hurting you at the end. You literally just shrank your tax deductions. So please, my friends, stop doing that. If you have any extra cash, put it towards your primary home mortgage. Now let me show you a 4th way, the way that no one has told you about. Every one of those 3 ways has the same flaw. They all ask you to bring out money, bring out hours, bring out luck. Rental cash damming asks for nothing new from you. You do not need to bring out extra money to gain the benefit of this strategy. All you need to do is rearrange the way that you're currently using your money. This entire strategy, rental cash timing, is based on this. If you're going to get anything out of this, this is a sentence you're going to take away. Whenever you borrow to invest, and there's a reasonable expectation to make money, i.e. rental income, you are allowed to deduct the interest costs. So let me say it again. This entire strategy, rental cash timing, is based on this one sentence. Whenever you borrow to invest, and there's a reasonable expectation to make money, you can deduct the interest costs. So if you borrow money to buy a boat for personal use, that's not tax deductible. But if you borrow money to run your landlord business, now that interest becomes a write-off. So here's rental cash timing simplified in 3 steps. Step number 1, please stop using your rental income to pay for your rental expenses. Because there's no rule in the CRA workbook that says you must take your rental income to pay for your rental expenses. The only reason we do it is because that's what we've been taught to do. Instead, step number 2, what you're going to do is you're going to take your rental income and you're going to prepay your mortgage, your primary home mortgage, every single month. And this is on top of your regular P&I payments, just the same as before. And then step number 3, all of your rental expenses, your mortgage payments, property taxes, condo fees, insurance, utilities, repairs, all of it is going to, all those expenses are going to come out of a re-advanceable line of credit. So what's happening now is your bad debt is shrinking really, really, really fast. This is the mortgage on your primary home. While your line of credit, your good debt is growing. And because it's growing, you have more tax write-offs. So, that hard-earned cash that you give away to the government right off the top when you work every single day, well, you're going to get back some of the hard-earned money. Keep in mind that your total debt hasn't changed. We're just decreasing the bad debt faster and increasing the good debt at the exact same rate. So all we did is rearrange the way you're currently running your landlord business. And that's it. Now, let me give you a quick example. There's a family that I work with. They make $300,000. They had a $500K mortgage and they're on a 27-year amortization. With rental cash timing, they'll have it paid off in 17 years. That's 10 years gone with no change in their family budget, without any extra cash input. They didn't go earn more money. They didn't cut back on things in life. They didn't sell anything. They just stopped doing it the wrong way. So don't take my word for anything I say. Scroll down below this video. You're going to see live testimonials from my landlord clients who have applied the strategy of rental cash timing. Everything is in their own words, not my words. So think about it, what this means to you. Mortgage freedom 8 to 12 years earlier than planned with no extra cash input. You're not sacrificing today for something. You're not sacrificing today for something for tomorrow. Now, here's the honest part. Everybody's situation is different. Everybody's numbers are different. So this is a strategy. It's not a guarantee. Okay, it's a strategy. So which is exactly what I'm going to do for running on our call. When we get together on our call, we're going to run your real numbers. So I invite you on our call, bring your numbers, bring your questions, and I look forward to chatting with you. Thanks so much, my friends.